Good morning. It's a pleasure being with you this morning, although I wish it could be in Seoul. I'm going to talk about my review of 2020 and my ideas about 2021. Of course, the big story last year and continuing into this year is COVID, but also the lockdown of the economy that was accomplished to prevent the spread. We had, as a result, in the second quarter of 2020, the worst annualized quarter in history for US GDP, down 34%. We also had a 33% decline in the S&P 500 from February 19th to March 23rd. But then, as you well know, the Fed and the Treasury announced their countermeasures. They restored faith in the recovery. They created wide open capital markets with the most high yield bond and senior loan issuance ever. Therefore, there were no credit crunch. Defaults fell short of the projection by roughly half. The buying opportunity was limited. And of course, we've had a 87% rally in the stock market from the low on March 23rd to April 23rd, last Friday. At Oaktree, we came in a conservative posture because we had caution. We felt the markets were vulnerable to an exogenous shock. We had no idea what it would be, but we have to know when it's vulnerable, and it proved to be. But it was a very good year at Oaktree. It was our highest year ever for capital raised at $30 billion, and in capital investing, nearly $17 billion from closed-end funds. We had excellent performance. We resisted declines early in the pandemic, and then we went from cautious to aggressive. But then, of course, when the buying opportunity ended, back to cautious. Most of our credit strategies were down less than the benchmarks in the first quarter, and they stayed ahead of the benchmarks through year end. We put money to work at the lows. We also had excellent productivity from our employees working from home, and we established ESG as a separate discipline and appointed a full-time head. Now, talking about the outlook for 2021, obviously, the important thing is that we have the vaccinations underway. I believe that we will accomplish herd immunity sometime in the third quarter. In most places, cases are down substantially, and certainly hospitalizations and deaths. We have an economic recovery underway as well. The first quarter will be quite strong when the results are announced, and I think the GDP will be up 6 or 7% for the full year, perhaps more. The US consumer in particular is in great shape. Because of government benefits, we had the best year in personal disposable income in 20 years. Above trend income and below trend spending, because spending was difficult in 2020, caused an increase in consumer balance sheets estimated at $1.8 trillion. And that's a lot of potential spending. The Fed will remain accommodating, and there's no reason to expect an increase in short-term interest rates anytime soon. Short rates are extremely important. There's also reduced political uncertainty. I believe that the tails of the bell-shaped curve have been pulled in because we have a more predictable government at the present time. Asset prices and asset valuations are high, but I believe that their high levels are justified by today's ultra-low interest rates. We have the lowest rates in history, and valuations are tied to interest rates, so the lowest rates in history would justify the highest valuations in history, but we certainly don't have them today. Most importantly, I think, we are at the beginning of a period of prosperity, and that is usually not the case when high security prices are reached. So on the one hand, we might say it's unfortunate that we have high security prices at a time when the economy is low. But on the other hand, we can be glad that we have an economy which is looking into a recovery at a time when security valuations are high. It all depends on on how you look at it. There are cons, and I'm glad to go through them. First of all, the high valuations, as I say, are dependent on the low interest rates. And for their continuation, we have to assume that rates will stay low. The Fed has indicated its intention to keep interest rates low for 2 or more years. The question is whether they'll be able to. And that brings us to the matter of inflation. There is the threat of increasing inflation and rising interest rates. Number one, the implications of what the government is doing, flooding the economy with additional liquidity. I estimate 5 to 7 trillion last year, slightly less this year, and then less again next year, but perhaps 15 trillion of additional liquidity into a $20 trillion economy. That's a big number. Historically, we would think that that kind of additional liquidity would be inflationary. On the other hand, inflation is very hard to predict, and certainly we haven't had any to date, despite 12 years of deficits and low interest rates. The Fed denies that it's concerned with inflation, but of course it is invested in suppressing inflationary expectations, which once established can be very hard to reduce. We have the adoption of the modern monetary theory attitude. The people in government who are more in favor of spending justify their ability to spend by saying, according to MMT, that a country in control of its currency does not have to concern itself with deficits and debts. I think it's just a theory, unproven, and I wouldn't want to bet everything on it. The government seems to be betting a lot on that. It's passing trillion-dollar spending bills without specifying how it's going to pay for them in many cases. Additional things to worry about, we have the prevalence of optimism and risk tolerance in the markets today. And a high degree of optimism and risk tolerance is always a concerning factor. We have the speculative behavior of certain stocks, including the meme stocks like GameStop and AMC and companies you've read about. We have retail buying, options buying, and buying on margin at a very high level, which is normally identified with speculative markets. We have heated bidding for deals whenever new issuance is announced, and deal markets are very strong, new issue markets are very strong. We have the ease of doing IPOs, and particularly IPOs of money-losing companies. And we also, some of these perform very strongly on the day of their IPO. And then lastly, we have the Buffett indicator, the ratio of stock market value to GDP at an all-time high. The risk compensation in today's market is skimpy. Spreads are narrow. And this is the result of the strong appetite for risk. And then finally, we have the possibility of exogenous risks. China and the domestic social and political division are two examples. How is one to invest in this environment? Well, specific to the markets today, I believe that asset classes are at equilibrium relative to each other in terms of prospective returns, but all prospective returns are low. I think that portfolios should be at roughly their normal risk posture, certainly not more aggressive than usual, but also not too much more cautious. I think things are in a mid-range. Portfolios should make allowance. If you're concerned about inflation and rising rates, you should, number one, not hold long-term bonds, and perhaps overweight floating rate loans, where the rate adjusts to changes in interest rates, apartments and other real estate properties, which have the ability to participate in inflation, and companies with growth potential and pricing power so that they can live well in an inflationary world. In general, I get the question a lot, how are we supposed to invest in the low return world that you describe? And this is the greatest problem today, for the simple reason that there's no easy answer. I see 5 choices. 5 no more. Number one, you can invest as you always have and accept that your returns will be lower than they used to be. You can reduce your risk out of concern for the market and expect returns that are still lower. You can go all the way to cash to prepare for a sharp correction and acknowledge that your returns will be near zero. You can go in the opposite direction and increase your risk in pursuit of a high return in a low return world. But I wouldn't want to increase risk today. Or you can increase the investment that you have in what I call special niches and special people, special strategies, special market sectors that you think may be inefficient, and the people who can garner the inefficiencies. The challenge is that each of these has disadvantages and drawbacks. In particular, the special niches, special people, number one, most of these we're talking about are illiquid, which is a limitation. And when you go into the alternative asset classes and the special niches and the illiquidity, you become more dependent on the skill of the individual manager. When you invest in so-called beta asset classes, market asset classes, where the performance of the market determines most of your performance, most managers perform pretty similarly in the long run. Which one you choose doesn't matter that much. But when you go into the alpha asset classes, where skill is the determinant, you hope to get an above average manager. You always stand the risk of getting a below average manager and enjoying negative alpha and a drag on performance. So none of these alternatives is ideal. None is risk-free, but that's all we have. There are no other alternatives for investing in a low return world. The bottom line for me, as always, is that there is no magic answer other than superior skill that provides high returns safely and dependably. And that's especially true in a low return world. Thank you very much. I hope you have a wonderful conference.